Welcome back everyone to the Lunch Money Investing channel. Today, we got some interesting macro data that could be impacting your lunch money. Inflation just hit its highest level in nearly 3 years. Headline PCE inflation jumped to 4.1%, a level we haven't seen in years. Yet, if you look at the stock market's reaction, you'd think that nothing happened. There was no massive sell-off, no panic, no emergency headlines. So, why did Wall Street stay relatively calm despite what sounds like terrible inflation news? The answer is the headline number only tells part of the story, and expectations matter almost as much as the results. And when you dig underneath the surface of the report, it becomes a much more nuanced story. Some parts of inflation actually came in better than expected, while others remain frustratingly sticky, and understanding that difference is incredibly important because it could determine where interest rates go from here. So, today, let's break down exactly what happened, what surprised economists, and what it means for investors going forward. Let's start with the numbers everyone was watching. Headline PCE inflation, the Federal Reserve's preferred inflation gauge, rose 4.1% year over year, exactly matching Wall Street expectations. Now that's important. Markets don't react to whether inflation is high or low. Instead, markets react to whether inflation is higher or lower than expected. And because the headline annual figure landed exactly where most economists predicted, there wasn't much reason for investors to dramatically reprice. The market already priced in an inflation rate of 4.1%. So, from that perspective, there's not much for the market to do. Looking at the monthly data, things actually came in slightly better than forecast. Headline inflation increased 0.4% month over month, compared to the market expectations of 0.5%. Core PCE, which removes volatile food and energy prices, increased 3.4% annually, in line with expectations, and just 0.1% above April's value of 3.3%. An acceleration, sure, but again, in line with expectations. Monthly core PCE came in at 0.3% versus expectations of 0.4%. Compared to last month, it was again an acceleration from 0.2% reported in April, but it was cooler than expected. So, overall, not a perfect report, a bit of a mixed bag, but certainly not the disaster that would have forced investors to rethink everything. Based on the latest report, the Fed remains likely to increase rates just one time later this year, and that's largely why markets remained relatively composed, with the S&P 500 closing up 0.14% for the day, while the tech-heavy Nasdaq climbed 0.81%. Now, here's where things get interesting. The biggest reason headline inflation reached a 3-year high wasn't because inflation suddenly became a broad-based story. It was largely because of one category: energy. Gasoline prices were responsible for much of the increase. Energy goods and services jumped 4% in May alone and 24.3% year over year. And we all know exactly why. The conflict between the US and Iran sent crude oil prices sharply. And though the spike was moderated by a massive globally coordinated release of strategic inventories, the 3-month closure of the Strait of Hormuz still made itself felt via higher gas prices at the pump. As fuel costs climbed throughout March, April, and May, transportation costs for everything went up, and they pushed headline inflation exactly where most economists expected: up. But here's the encouraging part. Many economists believe May likely marked the peak in inflation. Gasoline prices have already started to decline meaningfully during June following the on and off ceasefire between the US and Iran. If those lower prices show up at the pump, they should begin to pull headline inflation lower as early as next month. So while the annual number grabbed the headlines, much of that increase came from an area that's historically very volatile and that is already set to go down in the coming weeks. I dare say that inflation is transitory, or at least energy inflation is transitory. Now, let's compare that to the story that we see happening in housing. Housing has been one of the biggest inflation problems over the last several years, but it's finally beginning to turn the corner. Shelter cost increased only 0.3% during the month of May. More importantly, annual housing inflation has settled into roughly the 3% to 3.2% range, well below the stubborn 4% range we saw all of last year. And that's already a really big deal. Housing carries an enormous weight inside the inflation calculation. If shelter inflation were still running at last year's pace, today's core PCE number would almost certainly be much, much higher. Instead, cooling housing costs have acted as an anchor that's helping offset strengthening in other categories, namely energy. It's one of the biggest reasons overall inflation hasn't accelerated even faster. Now, Unfortunately, the latest report had some not so good news, or as some would say, bad news. Digging deeper, once you remove food, energy, and housing, basically everything you need to live, inflation is still proving surprisingly stubborn, still not near the Fed's stated goal of 2%. Economists often refer to this measure as supercore inflation, and supercore actually increased 3.5% year over year. Now, what's driving that? Financial services and insurance jumped 1.2% in just 1 month. Healthcare costs also continued moving higher. So, while many consumers may eventually see some relief at the gas station, the services people rely on every day continue getting more expensive. That's exactly the type of inflation the Federal Reserve worries about the most, because service inflation tends to be much more persistent than energy prices. Now, there was some bit of mildly good news in the report that didn't receive nearly enough attention, and that's that consumers are still spending, despite inflation running at multi year highs. Now, that can be by choice or by necessity. That said, personal income did increase 0.7%, while personal spending also increased 0.7%. Both these numbers easily beat Wall Street expectations. Think about what that tells us. Consumers haven't stopped opening their wallets yet. Households continue to spend despite elevated prices. From an economic perspective, that's a good thing because it suggests that the economy remained resilient, at least for now. But from an inflation perspective, it also means demand hasn't yet slowed enough to fully eliminate price pressures. In other words, consumers are still giving businesses the ability to raise prices. And if you give them an inch, they'll take a mile. So, where does all this leave the Federal Reserve? Overall, today's report probably won't force policymakers into an immediate reaction. The data didn't deliver a major upside or downside surprise, and that's important. Had Core PCE come in significantly hotter than expected, markets would probably be pricing in a much more aggressive Federal Reserve. Instead, the report simply reinforced something we already have known, and that is that inflation is improving in some areas. Housing is cooling, energy pressures should begin easing as soon as next month. But underlying service inflation remains too high, and that's exactly why markets continue assigning meaningful odds to another rate hike later in the year. Current market pricing still implies roughly a 60% probability that policymakers tighten policy before the end of the year. One hike of 25 basis points. The reasoning is straightforward. Headline inflation may improve over the next few months as gasoline prices decline, but if core inflation stays stuck around 3.4%, that's still nowhere near the Federal Reserve's long run 2% target. Now, quickly turning over to the first quarter GDP data, the final estimate was published this morning and it was a strong print. Overall, economists were expecting first quarter GDP figures to stay around 1.6. However, the latest figures came in much stronger at 2.1%. The large upward revision was driven largely by a downward revision to imports. Imports act as a subtraction to the GDP calculation, so revising imports lower leads to an increased GDP figure. Now, going forward, there are really three things investors should pay close attention to. First, do gasoline prices continue falling? If they do, headline inflation should begin moving lower fairly quickly. Second, does housing continue cooling? Because that's one of the largest components supporting disinflation right now. It's one of the largest components in the inflation calculation overall. And finally, can service inflation finally begin slowing? That's the biggest unanswered question. If supercore inflation remains elevated, the Federal Reserve may feel forced to keep interest rates higher for longer and add ammunition to the Fed's argument that a rate hike might actually be needed later in the year, early next year. But if inflation starts cooling, that could dramatically change the outlook for both monetary policy and the stock market. So while today's inflation report may have looked alarming at first, the details paint a much more balanced picture. Yes, headline inflation reached a 3 year high, but much of that increase came from a temporary, hopefully, energy shock. Housing continues moving in the right direction. Consumers remain surprisingly resilient. The real concern is that underlying service inflation simply refuses to cooperate. And until that changes, the Federal Reserve probably isn't ready to declare victory quite yet. Anyways, that's it for today's video. As always, I'd love to hear what you think. Do you believe inflation has peaked? Or do you think we're entering another wave of higher prices? Let me know down in the comments below. And if you found this video or this breakdown helpful, make sure to like this video, subscribe to the channel, and I'll see you on Sunday when I provide my full portfolio breakdown and overview. And remember, always protect your lunch money. See ya.